Now we're going to turn within the U.S. and start looking at some demand drivers. What are some of the impacts that we've seen from Colonial, and how is that impacting some of the numbers so far? So when we look at this chart specifically, this is talking about finished gasoline, jet fuel, distillate, and residual to show, some of those mobility fuels and what is happening in general. So we always have that rolling 4-week average just so you can get an idea of kind of where do we sit normally, how does this typically function. So the average was pulled up based on this large increase this past week to 14.824 million. So when you think about the current right now is 15.42 versus last week's of 14.79. So our expectation was to go from 14.8 to about 14.3 to kind of see some of that move down, and then see that average come closer to about 14.2 million. Instead, we had this big residual shift up. So here you can see that on the thinner yellow line that you had that big move up. Again, you had Colonial restarting, you had the shortages. When you look at just, okay, well, what happened at the gas stations as we talked about with Gas Buddy data? Gas Buddy had almost 10,000 gas stations that were out of fuel. So you had this huge pull forward as people panicked. They went to go get gas. Then they filled up their containers to make sure that they had some excess. So now you have a glut or inventory that has been transferred from the gas station to the end user. So now you're going to see a little bit of that taper. You also had, it takes time to fill up those gas stations. So then you had people that were concerned on, well, how long will the gas stations be empty? Then that means that they're going to drive a little bit less to ensure that the gas tank that they have goes a bit further. So then obviously things got back to normal. You had some residual issues in terms of available truck drivers, but that has since started to dissipate. So now you will see a natural pickup in activity. But then the question comes down to, well, what about price? How much are people willing to travel, and what are vacations look like? And we have some data on that just recently came out. So this is where we continue to see that you can see here we got back to 2019, and then you had that residual push as we had that move back up, with summer driving. And that's where we always want to look at. It's like, okay, well, how is this going to impact Memorial Day? Are people going to get a bit more active, now that they've stored up? So this is where we expect to see a increase in Memorial driving, Memorial weekend, and that'll really kind of kick things off. But it'll just be dampened based on the timing of when is some of this move through the system. Could we have? So my expectation is this coming back down to about 8.2 million, 8.1 million. Could we see this residual stay a little bit higher or not come down as much? The answer is yes. It's always going to be a matter of how quickly could we get some of this movement through the system, and that's always a timing delay. Do we have additional hiccups? Is there something that's going to be this residual problem? And that's something that we're always looking at and trying to update, which is what we talk about on Friday. We try to provide some color, and then we do different threads on Twitter just to give people an indication of like, look, this is what's come out. Because of this, we think we're closer to where we should be, or you know what, we're going to have another little bit of increase, or at least not the drop that we were expecting because of XYZ. Then when we shift over to distillate for a moment, we actually had a fairly large drop down in distillate stock by about 3 million. So that now takes us 11.2 million below the 5-year average. And when you look at the backdrop, it's all driven by Pad 1 and Pad 2. Because Pad 3 is still 6 million over the 5-year, and Pad 5 and 4 and 5 are fairly flattish versus kind of their historics. So the delta remains in Pad 1, and that's where Pad 1 is the biggest, where the draw with being 11.7 million below the 5-year average, which is actually supporting flow. So as we said in segment 1, we're having an increase of shipments or imports of mostly diesel into Pad 1 from Europe, which is typically flipped. We typically go from Gulf of Mexico into Europe. Instead, it's going Europe to Pad 1. And here's where you can see that refiners are now actually shifting some of their percentages. So to give you an idea, the production of gasoline actually fell 2.4%, and production of distillate started to increase about 0.5%. Now, there's also something to be said about what is happening in the distillate pool right now. As we said at the beginning of COVID, and we tried to highlight, the kerosene or jet fuel can be dumped directly into the distillate pool. So now you're getting more kerosene that's being recovered. So you're seeing some of that drop down, and it's pulling it closer towards that 29-year average. Now, on the import side, we're 99,000 barrels a day over the 5-year average, and it's being driven by PADD 1, and that's something that's going to continue just based on what we've already have slated. So when you look at the typical storage levels over the last 29 years, this is typically where we already should have started to see an increase. Instead, we saw another big decline. And this is more on kerosene being pulled back out, and again, kind of maintaining that recovery and seeing this drop down. Now, we're still going to see draws coming out of distillate just because trucking remains very strong. That's something that has been a strong carryover from 2020, and I don't see that stopping anytime soon, just given the amount of shortages that remain in the on inventory side, on getting things through the system, which is going to keep a lot of that flow coming in that demand, which is being reflected here. So here you can see that on a 5-year basis, we have a new seasonally adjusted high. It's just shy of the high that we saw in Feb, but again, this is still a net positive. Now, the other thing that we see is this big drop. So what is the big drop? Well, a lot of truck drivers will their goal is to deliver as much as they can and then be home for the holiday and then go back out on the road. So you're also getting this last push, then you get the drop down, and then you start to see some of that normalcy. Now, you also have, because this is distillate products supplied, what Colonial doesn't just move gasoline, it also moves diesel. So when you look at the timing delay in terms of, okay, well, when do we start to see some of this normalization? Here's where I think you're going to start to see some of this normalizing, and that's where you're going to get a little bit of this drop down. Now, it won't be as severe as in gasoline just because demand has been strong the whole way through. Gasoline demand has gotten stronger, but not to the diesel level. So that's where I think the correction is just going to be smaller on the diesel side. Here's where you can see that the load availabilities, the truck availability, load availability is coming down just because, again, that rush to deliver ahead of Memorial Day, then you get a little bit of a lull for the holiday, and then you see that pick back up quickly, which is, again, the market demand index, it's off the highs, but still, when we look over the last, through pretty much 2021, it's still easily at the top of the range, and that's where we think it'll remain. The problem that's going to come into play now is this steady increase in rates as we look at diesel prices going higher, as we look at just that inflationary measure as we analyze cost. Does it make sense now to try to use more rail, a little less trucking, to try to mitigate against some of these increases, because diesel prices just continue to move higher, trucking rates continue to move higher because of that, as well as labor costs, because there is that shortage, depending on what region we're talking about, what type of truck driver we're speaking of, which is going to put that bid beneath that rate, which, again, when we talk about that movement of cost through the system, if we want to talk about inflation, a lot of these different metrics is coming into with and getting wrapped into a lot of these rates. So then when we look at the rail side, rail continues to move higher. That's something that, again, is just going to remain robust. And when we look at the intermodal side, intermodal is now really to the high double digits. And it's going to stay there just because of that sheer demand on moving things through the system, trying to refill the inventories. We talked about it last week. We showed those huge drops in inventory to sales ratios, the biggest ever. April was the first time ever where sales actually went above what inventory was holding. So again, there's companies have no choice, because if you look at the supply chain and you look at the cost increases, they'll say, well, I'll live out of inventory while these costs normalize. You don't have that luxury. And then based on the Fed data that came out in the econ show, we're going to go through again, the updates on prices paid, prices received, shortages, orders filled, orders unfilled, new orders, just to show just how tight the supply chain really is, which again is going to be supportive of rail. And when we turn to import volumes, this is where we start looking at, okay, import volumes have essentially stabilized week on week with more behind it. So we want to start to see this drop a bit more because we want to see an acceleration point. Now, as California continues to open, as things start to normalize on the port level, we'll start to see an acceleration, which should help move some of this capacity into the system. Now, that's easier said than done because you still need containers to put back on the boat to send it back to its location, whether it's somewhere in Japan, because right now we're talking about Los Angeles, so that's heading over into Asia. You still need to see that movement, and because of the shortages that we have on unfilled orders at the U.S. Manufacturing level, the speed of getting essentially containers back to the port to get reloaded is also causing these delays. So even though we want to export and faster and import faster, you can see how there's a struggle on both sides of that equation. So then when we look at heat and cooling, we had a nice little surge for this past weekend. And now we still will get a bit warmer, but closer to the seasonal average. You can see across the Midwest and across the East Coast. So there's not too much to say. And then you're going to get some decent heat waves coming into the West Coast. And again, this is just showing some of that demand profiles when we look at people eating out more, things getting back to normal in terms of some of these usages of product. Now, when we look at gasoline draws, this is coming back to, we had a draw of 1.75 million, 7 million below the 5-year average. But when we turn to the general shift here, you can see that we're still above the low point for 2021. And that's why when we look at comps, the comps are going to get harder as we typically see a very steady draw coming into essentially, as you can see here, it begins shocking Memorial Day and then accelerates through the end of August. Then we start to see that rebuild of gasoline storage. But imports are the ones that are gonna change this, because we already have refiners that are near max capacity. They've pared back a little bit, but imports are still accelerating. As we said in segment one, we have about 3.77 million tons for May. We have about 1.1 million coming in through May 29th. So we get this last surge, but then we already have a strong June because some cargoes were signed up during the colonial disruption, and spreads still remain robust, attracting additional cargoes. So imports are going to remain a constant threat in terms of kind of where the storage is, which is why we keep saying that, yes, gasoline stocks will draw, but the rate of change is going to be very slow. And then that's going to get us elevated versus historics, more so just because we're not seeing that drawdown. And that's really because the global market still remains in this light distillate or gasoline glut, sending it into the U.S. markets, which is why we're going to see those imports remain over 1 million barrels a day. Now, blending components, again, speaks to just there's still that elevation in terms of what is available, sitting there at only 3.5 million below the 5-year average, and had a very different drawdown. And the other side is, when you think about Colonial, you're selling a specific grade. So that could be measured in RON. And as that goes through the system and then it gets to its end location, it then gets blended. So this is kind of showing that there is a delay in terms of what was put into the pipe and what is being blended. Now, there were EPA waivers that allows for less blending, or something closer to winter grade versus getting closer to summer grade, because Memorial Day weekend is when you have to start selling summer grade. That's where we're going to start to see some of that shift. And when you look at gasoline yields at the refining level, as blending components remain elevated, they can make gasoline and diesel at the same time, depending on what kind of crude they're running, but they'll lose some of the aromatics, which will be fine, especially because we're still fairly close to that 5-year average, and that'll shift, and that'll put more distillate in storage, and then that'll keep a certain amount of gasoline in storage as well. Now, when we think about vacations, we already talked about what Gas Buddy had. We had talked about how more and more people were concerned about what are gas prices, which continued to trend higher. And as we were saying, that we expected to get close to about $3.03 for the Memorial holiday. But this is looking at the Conference Board vacations intended. So this is for April. So here you can see that we had an expectation get much better as we came into the year. And this is really indicative of those who wanted to get vaccinated. So we had said that if you wanted to get vaccinated and travel, you did. There were people that were like, I need to get out of this house. I need to get to Disney World. I want to see my family. I want to get to Universal. I want to just get out of my house and travel 3 hours away just to stay in a hotel for a weekend. That is this pent-up demand side where you had this big spike. We did have an increase coming into the summer. So it's just, and I'm sorry, the x-axis is a bit skewed because it's every 3 years. So this red dot is May 2021. So we're looking at what has happened over time. So you had that residual bump when we looked off the lows coming into the 2021 summer. And now you're going to continue to see that as people did stuff after they got vaccinated. But what is going to be the continuation? Now, is this going to be the low? No, we're going to continue to move up. We're going to get closer towards, that 45. It's just money is still an issue. Travel is still there, like as we've shown in the EIA and in the other EIA shows, as well as the economy show. There's still a residual amount of people that are not willing to get back to normal yet. And that's the delta that we continue to see is there, because there are some people that are very passionate about getting out, and there are some people that are, I'm going to wait a minute. And so it depends on who you're talking to, on what they think is going to happen. It's like, well, my friends are doing this and my friends are doing that. It's like, that's great. Like, I think that is a positive. We're starting to get some of this normalcy. But there's also a part of the country that isn't. And that's where, not to call out political parties or politics at all, but when you're talking about it, we want to look at what is the data showing? Where are we on the data side? And this is where we're at these 2008 levels. And then when you translate 2008 travel into today, we're still below 2008 travel. So there's still some upside. And you could say that as we get into 2019, you're going to start to see some of this acceleration. But Gas Buddy, their estimates for the EIA supply numbers were for about 8.1 million barrels a day, which is kind of right around where we were expecting to be, as we said last week, which just means that at least we're not crazy, but you are starting to see the data get better on the Gas Buddy data overall. So we're starting to see a little bit of an increase, up 4% week on week for Tuesday. It's still a little, it's still trending in the right direction as we continue to see this movement through the system, but it's not, everybody is expecting this grand reopening, but we just keep saying that prices matter more. And just given where inflation is and where we are in the cycle of companies passing down that cost, there's still a lot to be moved through the system. And at some point, the consumer will reject it, we'll get stagflation, but there's still more residual to come down that pike. And that's when we turn to gasoline prices. So now we start to talk about gasoline prices. So right now we're at $3.02. It's down small by about almost a penny. This is kind of right where we were saying $3.03. Maybe you get a move back to $3.05. It's unlikely because some of this price is also carrying, the premiums that we saw from Colonial. So there's some of that back and forth. Now on the other side, when we look at diesel prices continue to trend higher. They're now over $3.25. And again, this is where we're starting to top out. We don't think diesel prices get that next bump, but we think that there's a lot of supply demand that's going to keep us at, let's call it between $3.25 and $3.27 and keep us fairly fixed within that level over the next few weeks. The gasoline side is the one that we think you're going to get that general trend back up as we continue to see a push towards $3.05. And where is that being driven? When you look at Pad 5, again, anybody that lives on the West Coast, I'm sorry. As we look at Pad 5, which is currently printing at $3.70, which speaks to, again, moving a lot of that product from Asia into Pad 5 as we get that continuous flow down into the system. And this is just looking at, as we talked about with the blending components, where we've essentially just gone flat. And when you look at the general trend over the last 15 years or so, we start to see a rate of change going down. Instead, we're just going sideways, which is why the comps get a little bit easier as we look at over the 5-year average and what does that mean going forward. Now, when we look at implied products supplied going back over the last 15 years or to 2006, you can see that big shift up. And that's where we were expecting to have that drop. But again, we had that big move up to about 9.479 million. And this is where we think you're going to get that big move down. Now, our expectation is to get a big shift down to about 8.1, even though we did get a move up, or I should say about 8.2. Because of this last shift up, we could get 2 shifts down instead, where one is a little bit smaller and then that next residual, and then we start to continue to see that grind higher as we get into summer driving and some of the residual issues coming through, which is why we talk about the four week moving average to try to get the noise out, because that is what the Colonial has done, is inputted a lot of noise as the consumer responded to not only just the Colonial pipeline going down, but then another surge after you had gas stations running empty. So then when we put it into context, here you can see over the last 5 years, where we sit. So we're back above where we were in 2019. And if you look at this spike to the highs in 2019, that is the residual following Memorial Day. So what happens? And this is what we were talking about, where the Colonial pipeline situation kind of pulled forward what we normally see for Memorial Day, where people go fill up to go drive to their parents' house, their friends' houses, their some longer vacation, and that pulls through from the retail side. So then the retail signals that they need more coming from the system. So you typically get this spike following Memorial Day. So you get an increase ahead of it as they prime the pump. Then you get that movement to the consumer, and then you refill what was gone, what had moved through the system. Instead, we saw that move through in size ahead of Memorial Day because of the Colonial pipeline, which again will take some of that residual out. Then when we turned to propane, we actually had a draw. So we had a draw of 360,000 barrels. And this is now putting us exactly where we were in 2017, which is why we've been talking very much about 2017 as a good point of pace to look for. So now this is where I think we start to get back higher, but exports continue to be strong and will remain strong even though we've seen price increases, just because it still makes sense to crack propane, or I should say LPG, versus the other options, especially when we start turning to ethylene export, or I should say ethane exports, as China brought on a new facility. Now, when we start looking at, and the reason why I talk about ethane is because, when you look at ethylene and propylene, there's going to continue to see that residual move into with the Asian markets. On a new COVID cases, the trend remains strong. Only 189, almost 190,000 new cases. But again, the movement is in the right direction. Now, the lockdown indexes are continuing to loosen up. You're continuing to see more mobility, more traffic. Things are easier to do. But when we look at some of the residual cases on what is happening with the underlying economy, that's where we turn to what is happening with jobless claims, unemployment. These are things that we always cover and we talk about in the economy show, especially as you see consumer confidence coming down a little bit, or expectations for the future starting to get weaker. And think about, what does that mean in terms of expectations coming full circle to that vacation side. If you're okay with right now, but you're concerned more and more about the future, then you're going to try to preserve capital instead of trying to spend. And then you also had individuals who bought new homes, bought new cars, bought new stuff after moving out of the urban setting. Those individuals may want to have a staycation, stay local, maybe not have the disposable cash after putting down a down payment and other, because as we've been talking about, it has been a very competitive market, which requires more cash on hand, which is going to, again, take some of that free floating cash out of people's abilities to go to that extra vacation or take that vacation, which may instead be local or at the park. Which is why one of the things that we've been talking about pretty aggressively is that parks are going to continue to become a bigger piece of the pie, as you saw with last year, where when you want to stay local but still get out, you're going to go to the park. And that's why we think that you're going to continue to see an elevated amount of park activity as work from home, where that residential remains elevated, but people continue to trend towards the transit stations. But when you look at the overall 7-day moving average, there's not much change on the mobility side, especially when you start to factor out some of the noise. Now, Apple's showing, we're at this fairly tight range when you look at the U.S., but this is also every time you search, not every time you drive. Now, I know for myself, because I'm neurotic and I hate traffic, I will check multiple times, which again could count as multiple movements. Though, some of the ones that we've seen the biggest increases on are obviously Europe, but that's why we think that you're starting to get some of this flatlining in Europe. As you get back to normal, you're back above baseline. Now you start to see some of this kind of residual movement through the system. When we look at the U.S. vaccination is slow to touch. Not meaningful, but back to from 0.55 to 0.52. France and in Germany, Italy are staying fairly consistent in terms of their activity. The one that again remains concerning is India. Without the ability of getting additional vaccines, they have really seen some of that struggle in terms of getting some of that vaccinations. Now, we've seen second waves of infections come and go without a vaccine, and it's due to distancing and doing a little bit less. So you'll see the wave continue to come down without the vaccine. The question is, can you maintain that movement? Like the U.S. came out of our second or third wave, depending on how you want to quantify it, but it stayed down, and that's you had natural herd immunity in terms of the amount of people that have gotten COVID, now the amount of people that have been vaccinated. This will enable that to not see that spike. Now, India, that's going to be the dying question of, well, are we going to see that spike as things start to come back to normal, or will we just see the residual of people not willing to do as much waiting for the vaccine? And then when we turn to jet, we're back to the highs that we saw in March and early April. We had a build of 820,000, again, kind of priming that pump as well. But you're also just seeing it come out of distillate. Now, as we've been saying, there is a seasonal aspect to this, and we thought that you were going to get a little bit of a spike, but just back to those highs. Again, there's jet fuel also moves the Colonial Pipeline, so you're going to see some of those movements in terms of the jet fuel demand. and how is that moving through the system? Did you have airlines? We knew that several airlines were landing more often for refueling. These are some of those dynamics that have now been alleviated, and you didn't have airlines and airports rushing to get it. So again, we expect to see a drop down as well as we start to see some of that residual normalize. Now, departures fell 340 week on week. It essentially just takes back what we've seen added over the last 2 weeks. Here, when you look at what is causing that, it remains Asia. Asia Pacific is continuing to see that drop down. The U.S. is essentially flatlined. We've had a little bit of an increase in departures, but really not too much in terms of North America. But when you look at just what is happening in the rest of the world, here you can see Europe is getting back to what we saw in those December months prior to the second wave, and back to where we really in December, not even back to where we were in October. So there's still some residual to go, but the rest of the world and Asia continue to see that slowdown. And when we look at vaccination delays, again, this is why we think there's going to be some of that residual shortfalls globally when we talk about jet fuel. The U.S. will be the bright spot, but it's the question of, well, what is happening in the rest of the world? And because kerosene can go into the distillate pool, that's why we talk so much about light distillate and middle distillate abroad, because a lot of this kerosene that isn't being consumed is going to be pushed into the system in a different way, keeping some of those product gluts that we keep talking about. Now, on the passenger side, we keep hitting the second time that 1.8, and then we pull back to about 1.47. We're still trending above what is the average between 2020 and 2019. But again, we typically see this surge when you look at as we head into Memorial Day. We'll see this increase, and then we're going to start to see the acceleration of travel as we go into kind of those midsummer months. Now, OpenTable, things are getting back to normal. The U.S. is now positive. And when you look at just weather, you look at people looking to do more, I would say that at this point, especially as Canada reopens, Germany reopens, you get some normalcy coming back through, we will likely be back to either flat or slightly above previous readings, which is a net positive. And here you can see in terms of just getting back to those normal levels. So now that we've talked about the U.S., we want to turn back into and look abroad as to what is happening in the physical market, what is happening with global exports, and where are some of these Asian shipments that we've talked about in segment 1 and segment 2 really going to show up, and how long can this really last, or is it permanent? And that's something that we want to talk about and kind of look at to see what are these movements going to be like over the next few months.